In this video, we will be talking about evaluating firm performance. We're approaching this from the perspective of a strategist, not a finance manager, but we will be using a little bit of financial data. As a reminder, we've defined strategy in this class as the set of actions a firm takes to gain and sustain superior performance relative to competitors. We read a Jimawa article that talked a little bit about what competitive advantage means and what's one source of superior performance. It's creating that wedge between your cost of producing a good or service and customer willingness to pay for a good or service. And that's a great starting point. But these things are not always easy to observe, and they're certainly not always easy to observe at a company level, especially for companies that sell lots of different goods and services and maybe market their wares to many different segments of customers who have very different needs, very different preferences, and very different willingnesses to pay. So using the kind of data that we actually can get our hands on, how do we know if a company is doing any good? So we'll talk about 5 basic buckets of data here. The most accessible are financial metrics, especially for publicly traded firms. It's very easy to get financial data, and you can look at things like profitability, sales growth. You can look at a stock price, which isn't always as informative. There's a lot of other things you can do with financial data. Marketing metrics, relative market share. How much of the market are you addressing versus your competitors? Some of that you're going to have to intuit or guess based on your knowledge of the market size and if you have data on your competitors' sales, which again, if you're competing against publicly traded companies, you probably will have that information. If not, you're going to have to do a little guesswork. There are a lot of survey-based measures you can use for marketing. Customer satisfaction, like a net promoter score or the lifetime customer value, customer acquisition. These are some of the things you can look at when you're trying to improve customer willingness to pay or reach new customers. Not necessarily an output, but an important input to the process is some of these HR and talent-related metrics, such as employee turnover and employee satisfaction and skills and capabilities assessments, especially in today's knowledge-based economy. People-based metrics are becoming increasingly important to understand. Then 2 buckets that are sometimes presented separately, sometimes together. Innovation, where you can measure things such as time to market, new product development, how many products have you created. Depending on the industry, you can look at things like patents as well in this bucket. And then operating performance. You can look at a variety of different performance metrics, quality metrics from the Lean Six Sigma process, like number of errors, timeliness in providing a good or service, and there's a lot of other things that, again, will vary a little bit by the industry. I'm going to talk specifically about ROE, return on equity, for a minute, in part because it's a pretty important diagnostic tool that we use when we're trying to figure out what's driving a particular company's performance. So return on equity itself is only a so-so metric, if you ask me, but it's one of the most popular measures of financial performance. And the reason why we use it as a diagnostic is because it's commonly broken down into 3 parts called the DuPont ratios. Also known as earns, turns, and, well, leverage doesn't sound quite as nice. But when we look at this and break down ROE into its 3 constituent parts, which again is all using very commonly available financial data for publicly traded companies, you can measure how well a company turns sales into profit, which also answers the question, how well do they control their costs? You can look at how well does a company turn its assets into sales. So how well is it doing at actually generating sales, that top line number on the income statement? And then finally, leverage. How are its financial decisions affecting its ability to kind of operate. This side is kind of operating metrics, and this side is financial decisions. So we oftentimes use this as a starting point just to diagnose where kind of discrepancies in performance might be coming from for a company. So management by metric is very popular, especially in the US. And one of the tools that's most popular is called the Balanced Scorecard. You may have come across it already in your studies. The idea of the Balanced Scorecard is to take more than just the financial or shareholder perspective, but also look at that kind of operating and innovations perspective, the HR talent development or learning and growth perspective, and that marketing or customer perspective, and use metrics from all these different categories to give a more holistic picture of overall firm performance. This kind of assessment can be helpful to understand where a company is doing well, where it needs to invest in new capabilities or new equipment, new processes, where it needs to build better rapport with customers. Essentially, it again can also be used as a diagnostic. However, a balanced scorecard is only going to be as good as the actual metrics that you choose to measure as part of your balanced scorecard. And the more complexity you add to a balanced scorecard, the more metrics you add, the problem is it becomes a more difficult tool to interpret and understand, because you may have conflicting information, or you may just have so much data you can't have a simple kind of message to communicate from it. Then you have softer and less tangible things like company culture. And how do you measure these things? Certainly some of those soft people skill type assessments might hint at it, but it's certainly not something that's easy to measure and manage and see regular change on a very short-term basis. So there's certainly movements away from measurement by metric, but it still remains the most dominant approach in the US. I also wanted to pull up Capital IQ and show you some examples of how we might compare companies to think about how different competitors perform. So I'm in Capital IQ and I've looked up Costco. When I look at Costco, I've pulled up some of their close competitors. And these are ones that Capital IQ has suggested, so not all of these may be really close competitors, but there's some names you might recognize. And I'm looking right now, let me just look at their net income margin or basic profit margin, and that LTM stands for last 12 months. So we're just looking at the last year. So when I look at this, I see a little bit of a range. And in fact, Capital IQ so nicely gives me summary statistics down here, telling me the high, low, mean, median. And I can see that Costco is a little bit lower than the mean in terms of a profit margin. Does that mean that they're not good at creating value for their customers? Not necessarily. It might just be the first place I turn to. Remember, there's those 3 DuPont ratios, and that's just the first of those 3 to understand how Costco is performing relative to its competitors. Another thing you might consider, besides for just DuPont ratio analysis, is looking at growth rates. So in this column next to those profit margins is year-over-year growth rates in revenue. So just how well is the company doing at generating sales, and how did it compare to last year? And if you look at that, then Costco looks pretty healthy, like a 6.3% growth rate. This again is 1 year. You're going to want to look at more years of data to make sense of whether a number is good or bad. So when making these comparisons, you need to compare across time as well as across companies to try and make it make sense. I'll also point out one other thing you can pull up in Capital IQ, which is kind of fun. They also have some industry-specific metrics, so not just financial data, but for example, for Costco, I can look at how many stores they opened in a given time period, how many stores they closed, and what they like to call same-store sales growth, which is very common in retail stores. So not counting new stores they've opened, if you just looked at the stores that were open 2 years ago, how did their sales grow? And so it tells you a little bit about how their existing stores are faring and helps you to understand if those variations in sales are just coming from opening new stores or if they're actually doing better in the stores they already had open. So that's kind of a fun one to check out. And depending on what industry or company you look into, you might have some other ratios there that might be really informative for your companies.